My portfolio is down, the market's crashing. I do have some cash to deploy. Not in any rush, but I want to make sure I make a really good decision with that cash because the performance of my portfolio is at stake. And if I can take advantage where there are some lower actual prices in the market where a company is now undervalued, then I'm very happy to do so. Deploy that cash. I've seen some messages. I know some of you are in the same position. So I'm going to show you what I'm looking at with my cash. I hope that may give you some ideas. Obviously, not a recommendation to buy or sell, just what I'm thinking. I'd really love to hear what you're thinking. So I've been screening a wide range of companies to potentially buy a stake in them. I want to try and find something that's really undervalued and has the ability to stay alive for the long term. Here are some of the companies I've been screening. Three of them are going to feature in this video. Very close to buying a stake, and in fact, I may have already bought a position in one of them. Stay tuned to hear which company that is. We start a massive shout out to Patreon supporter. Support's very appreciated. Really enjoying the discussion that we're having on Discord, sharing ideas about portfolio management and stock ideas. If you'd like to be part of this community, please consider joining me, and I'll share details around that later in the video. So 3 companies that I think are undervalued. Let's start right now. Okay, first up is Royal Mail. It's a UK logistics company, though they do have increasing operations overseas, particularly in Europe. So the headline for Royal Mail, according to the Morningstar data, is first of all a price to book ratio of 0.5. So this particularly attracts me. There's potentially a lot of value in this company. Trading dividends around about 6%, forward is around about 7.3%. Very attractive yields. According to the key ratios here, free cash flow is £500 million, though that may include some element of COVID lockdown boost. Return on equity is pretty decent, 12%, 6% return on assets, and debt to equity 0.38 according to Morningstar. Let's swing over to Simply Wall Street, see a little bit more. So 600 million in earnings, about 5% profit level. Not hugely profitable. You don't necessarily expect to massive profits in logistics. In terms of the dividend, there's around about a month at the time of recording until the ex-dividend date. They're actually saying on Simply Wall Street almost a 10% current yield. And you can see here when the virus situation came in, there was a drop in the dividend. So this isn't a kind of a dividend aristocrat as some companies are. There's that drop off, but it has been reinstated very quickly. Dividend per share is in the region of sort of 20 to 25p. Payout ratio well below 50%, close to 30%. The future payout ratio expected to still be below 50%, so that's good news. Confirmation of that good debt to equity level. Debt less than £1 billion, loads of physical assets, cash and short-term investments. Definitely the debt isn't a particular issue, I would say, at the moment. So the Yahoo data has got a trailing PE of 4, 4p of 5. These are very low figures. And again, price to book of around about 0.5. These feel like numbers that suggest value. They've got 7% dividend they've got here. Looking backwards, around about 20p. Also, we look at the share price of £2.80. That's a pretty big percentage of that £2.80. So these numbers that we're seeing here, they all suggest to me that there's a nice dividend and the P ratios look very attractive. Looking forward, not expecting any particular earnings growth. The analysts that Yahoo use. Look at the analyst view on Simply Wall Street. It looks like there's been a bit of a boost during the lockdown situation where a lot more people are at home, so a lot more parcels. So that profit's expected to actually drop and potentially be in that 300 to 400 million region. Free cash flow is currently 500 to 600 million. That's expected to be around the 400 to 500 million region. Look at the market cap of around about 2.5 billion. Yeah, that 4PE, you're looking at 5, 6, 7, probably in that sort of range. Now, what I've found here is last week or two, that Royal Mail have been dropped out the FTSE 100 index, which is the 100 largest UK listed companies, generally speaking. Likelihood is that many index funds are going to be selling. That could result in a drop off. That presents a buying opportunity. Valuation wise, Simply Wall Street is saying fair value of almost £10 a share, which I think is a little bit excessive. It's an interesting indicator. That is a discount rate of 7.6%, so that's not too bad. I do think it's probably slightly lower than that, fair value. Just have a look at what's been happening in terms of the market view of the company in the last 5 years. There's a peak of over £6 a share in mid-2018. Got all the way back down, just edging down over several years, pandemic time to getting towards £1.25, that sort of area. We got a shot back up due to the parcel boost, back to almost £6, and we're down again to £2.81. And this looks like perhaps some of the index sell-off starting, essentially. So it feels like this could be an interesting time to buy. The company's not going to fail, so rule one, don't lose money. I don't think I'm going to lose all my money on this. There's definitely a nice dividend. And sort of the long-term trend as they move towards a parcel business is certainly their favour. So everything so far looks really good from my perspective. Concern here, though, is that the last few days we've had this news that there could be strike action of over 115,000 workers. I suspect that is likely to go through. So that just makes me slightly nervous. Now, the strike action, if it does go through, may result in a lower price in the market. That could result in a more impressive buying opportunity. However, that's kind of guessing, because if it doesn't go through, or it's already priced in, then it won't have a negative effect. That's Royal Mail. Not very fashionable, but I think those are the best investments sometimes, the ones that aren't particularly exciting, a bit boring. Been around a long time, probably a lot less likely to lose money. Next up is Intel. Now, Intel, I already hold a position in my portfolio. That's the one that I've also added to. Here is what I've done with Intel. So I've added at 37.47. I've added a small number of shares. I'm probably going to add some more. For Intel, down 18% per annum. I'm looking at it now and thinking this is a very nice entry point to improve the position. We're looking at £440, so around about 1%, just over 1% in the portfolio. I don't have excess exposure. I think the long-term macro trends are in favour of Intel in terms of the chip making, the fact they produce the chips themselves rather than outsourcing like some of their competitors. Historically, they've produced huge free cash flows. And the next few years, their free cash flows are forecast to drop somewhat. And that is because of the capex increases that they are doing. So they're investing in new facilities. Once that goes through, the outputs in terms of the numbers should be a lot higher than they even were before. Now, Intel's been a massive free cash flow machine previously. Look at some of their valuation metrics here. Trailing P6, 4P11. So that's, again, it feels quite low for this sort of company, but I'm taking a real long-term view here. Intel's not going to fail in the next 10 years, but I can't see this sort of value that I'm going to lose money really in the next 10 years. Forward dividend yield is about 4%, so that's quite a handy little dividend to pick up whilst all this is going on. Just have a look at their most recent summary of earnings revenue, 77 billion of revenue. That did translate to almost 25 billion of earnings. That's what, 30-odd%? Yeah, 32% net profit margin. And we know that's going to drop for a few years, but it will be back up again as their investment program has finished and paid off. Payout ratio is very low on the current dividends, so that's nice to see. Enterprise value to EBITDA looks decent at around about 5 as well. Look at the PE ratio compared to competitors. See Micron, which is another one that I hold, a similar PE ratio. And then you've got some other companies there with higher ratios. Future return on equity is over 12%. Historically, return on equity has been 24%, and assets 14%. Good numbers, very good numbers. Financial health seems okay. There is a lot of debt in absolute terms, 37 billion, but there's a lot of equity in comparison to that debt. And cash and short-term investments does actually cover the debt, and you've got loads of inventory there as well. So I'm not worried about that debt. Now, look at this dividend per share, which is this kind of lighter line. It's been ticking up year after year after year, so it's really nice to see. Payout ratio in the future does get worse, 61%, but that's okay. I think having a quick look at fast graphs, which is quite an interesting valuation tool. See the black line here compared to the normal P ratio for Intel in the market, which are your blue and orange lines here. We are much, much lower than that. There's a big divergence. So again, it's a good potential buying opportunity there. Just to top it off, Simply Wall Street is saying fair value of $230. I do think that's a little bit exaggerated. Discount rate 7.4%. I don't think that's quite right. I think you're probably looking at a third of that really as the fair value. But overall, I've added to the position because I could just sit on this one for 10 years. I'm quite happy to sit on this for going anywhere. It's an absolutely key company. I can just collect that dividend and there should be some share price appreciation. Shout out the share site if you fancy a 10% discount. Do crack on and have a look at my link in the description below if you're looking for something to help you with your portfolio management and to give you compound annual return rates for all of your positions. Last but not least is Citigroup. See, Citigroup in the last 5 years has been all over the place. It's been up pre-pandemic 81, dropped all the way to high 30s, shot up all the way to almost 80 again in middle of 2021, and it's just been pretty much dropping ever since, down to high 40s. The reason I'm interested is the PE 6 for PE 7. Price to book around about 0.5, which is quite a good indicator for banking and insurance companies. Dividend 4.4%. 70 Wall Street view is fair values getting towards 70. They have got quite high debt numbers. That is something to watch out for compared to the equity at least. Now, the dividend has been ticking up then since 2015. Very nicely indeed, and predicted to carry on doing so. Payout ratio about a quarter, going up to around about a third, so still very nice. Morningstar corroborates this information in terms of price to book and the yields as well. Good margins. And of course, Berkshire Hathaway. Now, I don't know if it's Warren Buffett himself, but Berkshire Hathaway just bought a big stake in Citigroup. And Berkshire Hathaway have got very strong knowledge of American banks, so this fills with confidence. Fast Grass View, a very useful tool for looking at value of US stocks. Again, there's some divergence below the normal market P15 or the normal P that Citigroup's been trading at over a period of time of around about 11. Again, that suggests there could be some potential value there. It's a good indicator. So these are positions I'm looking to add to the portfolio. So I've already got Intel and added a touch. I'm very likely to add more and do a little bit more diligence on the other two. And again, I think they're probably likely buys for me. But what are they for you? I'd love to hear what you think on these companies, whether you'd like to own a stake in them or if you do already. If you're looking for other dividend stocks, of course, you can check out the video on screen now, and they could well serve you well if you're looking for regular income.